Good morning and welcome this morning to Getting Started with Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend, Michael Fairborn, who is a 30 plus year veteran of the financial markets. He is there to facilitate the conversation, keep that going, and help answer some of your questions in the chat. Speaking of the chat, if you're in the chat right now, welcome to all of you. I know we've got a number of new folks out here today, so we're glad to have you with us. If you happen to notice that that chat drops off for a minute or doesn't seem like it's flowing, just go ahead and refresh the page, and that may bring that chat right back up so that you can be a part of the conversation. If you're here with us in the recorded version, as many of you are or will be, please leave us a comment in the comment section. We'll respond to that as quickly as we can. So again, once we get into this discussion, Mike will be there to help answer those questions and facilitate the flow of information. It is cash secured put day in the Getting Started with Options rotation. That's lesson 6 out of 12. We're going to talk a little bit about the idea of selling cash secured puts. We've shifted our focus from being long options to now being the seller of an option to collect premium. So we're going to talk through this particular strategy. A couple of quick housekeeping items, though, before we get started in this discussion. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or solicitation of a particular strategy or account type or any individual symbol. If we talk about a specific symbol, again, remember it is simply for illustrative and educational purposes only. Options carry a high level of risk. They are not suitable for all investors. Make sure that you are aware of the characteristics and risks of standardized options before considering any option transaction. Now, when we are selling an option, as we are in this particular discussion, there are some concerns that need to be paid attention to. One, selling an option creates an obligation. We'll talk about that as we get into this discussion. Specifically in the strategy that we're going to talk about today, the obligation is to take delivery of the stock. So being put the underlying stock, having delivery of that underlying stock, and then having a long position in that stock means that there is potentially additional risk, and that is the risk of holding that stock if it goes down. So in this particular case, there is the potential to lose more in that transaction than was originally brought in premium. We'll talk through that discussion as we get into this conversation as well. We're going to use some technical analysis in this discussion. That is theoretical in nature, probability analysis, fundamental analysis, all of those are theoretical in nature as well. None of them guarantee the future success of a trade. None of them point out the future movement of the market. Schwab doesn't recommend the use of technical analysis or really any one single method of analysis as a sole means of investment research. Investing involves risk, including the loss of principal. Rolling strategies that we may talk about in this particular discussion is not a magic wand. It is not a removal of transaction costs. It may entail, in fact, additional transaction costs, and it also depends on the liquidity of the target. Now, anytime you're short an option, and it's an American style option, there's the potential for that obligation to be assigned to you. That can happen at any time in an American style option, whether you're in the money, out of the money, or at the money. It does not matter, and it doesn't matter how far out. Inadvertent or purposeful early assignment can happen. So we'll talk through that as we get into this discussion. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. Paper money is a great learning environment. However, it is not a guarantee of future success, number one. Number two, it does not facilitate certain things, specifically the early assignment of short options. You won't see that happen in a paper money account. And fill prices for orders in the paper money account might be a little bit different than you might experience in a live trading account because they are derived algorithmically, most often happen at the midpoint, whereas that's not necessarily going to happen in a live account. That's going to be determined by market forces. As always, past performance, no guarantee of future results. So I'm going to pop out here into our next discussion. So somebody asked me the question, where are we in this rotation? Here we are on lesson number 6, short puts, also referred to as cash secured puts, because in order to do this and not have theoretically unlimited risk, granted the risk is finitely capped, but it is theoretically unlimited risk, um, we're going to be talking about cash secured puts, where the seller of the put option holds capital in their account equivalent to the amount of the purchase price of the stock minus the premium that would cover that obligation of having to buy the stock at the strike price. So we'll talk through that. Next week, we're going to talk short put verticals. Next week after that, we're going to talk short call verticals and on through this discussion, long call and long put verticals, protected puts, and then kind of the catch-all 7 things I wish I had known when I started. Now, I want to do this really quickly because several people are asking, and I know many of you are new to this discussion. Where do you find the previous sessions in this list? And I'm going to take you to the page really quickly, and I'll show this page to you again. But we're going to go to Trader Talks, the Trader Talks webcast page at YouTube, youtube.com/@Trader Talks webcasts. And we have playlists as well as individual videos here. So what I'm going to do is I'm going to type into this search box, getting started. And I'm just going to hit getting started, and that's going to show you a variety of different getting started webcasts. Here is the Getting Started with Options playlist. Getting started with options, we have getting started with technical analysis, we have getting started with Thinkorswim. That are some great playlists, but here's the Getting Started with Options playlist, and you can watch that. I'm just going to quickly grab a link for you, and I'm going to post it out here in the chat. I know Mike would do that as well, but I'm going to put that out there in the chat so that you've got it. There's the playlist, the link to the YouTube playlist for Getting Started with Options. And so the last one we did was last week, lesson 5, buy right covered calls. You can also search for individual topics within this webcast structure. What I'm going to ask very simply that you do when you're here is you click on that subscribe button. It makes it easier to find the content. And Mike's putting that out there again as a reminder. Make sure that you click on that subscribe button so that you have access to those webcasts. All right, let's pop back over here to the Thinkorswim desktop, or actually let's pop back over here to our slides for just a second, because I want to talk through this discussion. Cash secured puts, what and why. We've talked a little bit about that along the way here. The basics of selling a cash secured put. We'll do a number of different examples, and we'll talk about some next steps from there, including going to the next webcast here in the Getting Started series. So what is a cash secured put? Very simply, it goes along with the idea of what we did last week and the week before in selling covered calls, but now we're flipping things over. So we know that when we buy a put option, we have a right to sell the stock to somebody else, which means the converse of that, when we sell a put option, is we have an obligation to take delivery of the stock from someone. So the put option is a contract, but sellers have an obligation to buy the underlying stock at the strike price at any time up until the expiration date of the put option. Now, I mentioned that cash secured component of this. That cash secured portion means that the seller of the option contract has to set aside or hold capital enough to cover the entire purchase price of the underlying stock minus the premium in the event that we're put the stock. But our expectation here is bullish. So there's really 2 thought processes here. One, some traders will use a cash secured put as a means to generate income. Maybe they are sitting on a large amount of cash in an account. They want to deploy that cash as an opportunity to generate income in the account. So they'll sell cash secured puts with the intent of simply bringing in premium when they sell the option up front, and then either letting the option expire worthless if the price of the stock keeps going up, or buying the option back at a later date for less than they paid for it and keeping the difference in premium to generate income. Now, one other possibility in a cash secured put is selling the cash secured put for the specific express purpose of taking delivery of the stock, being put the stock buying the underlying stock at a little bit of a discount because the expectation is that the price of the stock may go up, but maybe it's pulling back a little bit. That opportunity to buy the stock at a little bit of a discount, the amount of the premium that we bring in, is an attractive reason for some investors to want to utilize this particular strategy. And to answer P. Jammin's question, can you place margin secured put, or what's sometimes referred to as a naked put? Yeah, you can. Depends on your margin circumstances. We are specifically going to be talking about cash secured puts. So if you have questions about can you, given your current level of options approval and margin conditions, can you sell put options without holding cash? That's going to be a great conversation to have with your financial consultant at one of our Schwab branches. They'd be happy to go through that discussion with you. All right. So here's the how. As we put this, and just kind of thinking through the numbers. It has limited upside potential, right? The idea being that we sell the cash secured put, we bring in that premium. That's the most that we can get in the trade. That's the premium that we receive. Our max loss comes from the break-even point, the price at which we would have to buy the stock minus the amount of premium we're bringing in, all the way to zero. So there's a baseline assumption that to get to that max theoretical loss, the price of the stock has to go to zero. Is there a possibility that the stock could go to zero? Yes. Is it a likelihood? Probably not. Now, where we get to that break-even point again, I'll just reiterate, it is the strike price, the price at which we agree to buy the stock, minus the put premium that we bring in this discussion. So the first really kind of foundational question, perhaps, that a put seller, cash secured put seller, has to ask is, do I really, truly, honestly feel comfortable owning shares of the stock that I'm selling cash secured put on? Because that is a possibility. Could happen. You could be put the stock. So you have to ask that question. What kind of stock do I want? So generally, put option sellers look for stocks that are moving in a neutral or sideways or bullish trend. The expectation being that the price of the stock is at some point going to go up. Selling a cash secured put on a downtrending stock that is in a strong downtrend may be a situation where a put option seller wants to acquire the stock, but at some point then you have to ask the question, why do we want to own a downtrending stock? So there is that underlying stock component. So we have to be comfortable buying the stock. It has to fit our characteristics of stocks that we are comfortable owning. So if you have an objection to owning a particular type of stock, or they work in a particular industry in which you don't want to have exposure, maybe consider not selling a cash secured put on a stock that you wouldn't feel comfortable owning. I'm saying this in a lot of different ways because it's an important question. You have to answer that question. Am I really, truly, honestly willing to buy this stock? Okay. Now, John asks another great question, and also a good question for your financial advisor or financial consultant at the broker or at the branch. Do you have to actually be in cash, or can it be in a mutual or money market fund? So it could be cash or cash equivalents, something that could be settled quickly to provide cover for that obligation. Has to be in the same account. You can't have cash in one account and sell covered or cash secured puts in another account and expect that that's going to be used as cover for that position. All right. So looking for defining a support level, looking for something like a close above the high of the low day is an indication of maybe a bounce. And then from a operational characteristic, stocks that have generally higher trading volumes, options with higher trading volumes, options with tighter bid-ask spreads. Traders are typically not trying to do cash secured puts on diamonds in the rough that nobody knows about, that are going to make a big move to the upside because it's a gain limited trade. So trading cash secured puts on stocks that have a lot of liquidity and options that have a lot of liquidity supports the idea of trading where the people are and getting in and out of the trade in a smooth fashion. So neutral to bullish outlook. Expiration dates typically 20 to 50 days to benefit from time decay. We're going to talk about a couple of examples that are a little bit shorter than that as well, which is just fine. So the idea of selling a cash secured put over 6 days and then doing it again, or over 17 days and then doing it again, or over 20 days and then doing it again, is an idea. Selling a cash secured put way out in time may not be an opportune or ideal scenario, because there's a lot of time for the price of the stock to move both up and down, right? So um, as we get to strike selection, we'll talk a little bit about that. We'll talk about position size. That's going to be based on the amount of cash. So John, I answered the question as best as I can answer, because I don't know the circumstances of the mutual fund that you're in, and I don't know the circumstances of your particular account. So I'm glad that you asked the question. I've given you some resources to be able to get the direct answer for your particular circumstances. All right, so let's jump out into the next portion of this. So why do this? Benefits, generating income, a way to acquire the stock, and a short-term trade potentially that could be repeated multiple times. The risks are they have limited upside gain. It could be assigned at any particular time. You could take possession of the stock, and the price of the stock could go down. And we could purchase the stock at the strike price at a time when the price of the stock has already gone down, and we're now assigned that obligation. All right, so let's jump out to the platform before we get into some of these additional considerations. Let's jump out to the platform and let's look at a specific example of a cash secured put. Now, again, this is for illustrative and educational purposes only. This is not a recommendation. This is Delta Airlines. And the reason I'm looking at Delta Airlines in this particular case, the base case of this is, one, I answered the question, am I really, truly, honestly willing to buy this stock? And the answer is yes. That doesn't make it a recommendation. The other reason that I might be looking at this particular stock is this, that the price of the stock is generally making an uptrend. It's been in an intermediate to long-term uptrend for some time. In fact, it's now rallied up. It's pulled back a little bit, and it seems to be bouncing up off of a support level right here at about the $78 range. Let me post the link to the playlist once again out there in the chat, so that you can access all of those other lessons, and that'll also be the location that you can get to this one, and then any others going forward is the playlist right there on the Trader Talks webcast page. So Delta seems to be bouncing up off of that level, that little bit of a level of support. I'm going to turn implied volatility on here on the chart in this view, and I'm going to look at where implied volatility is. Implied volatility is not exceptionally low, but neither is it necessarily exceptionally high in this particular case. Higher implied volatility is going to mean that the premiums are going to be a little bit juicier, but it also means that there's a bigger potential for the price of the stock to move. Lower implied volatility suggests that premiums are going to be small, and that implied volatility might go up, which may hurt us as the seller of a cash secured put, because it adds to the value of the put option. So I'm going to go to the trade tab here. Now that we've established that we've got kind of middle of the road implied volatility, I've got to bounce up off of a level of support. My level of support is at about the $77 or $78 level. I'm going to go to the trade tab, and I'm going to look at the option chain. And in the option chain, because of time decay, and because time decay generally accelerates as we get closer to expiration, I want to be on the shorter end of that curve, because time decay is going to work in my favor in this particular case. So I'm going to look at an expiration date, in this case, that is about 20 days to go until expiration. I'm going to go to the 2 July expiration. So 23 days to go until expiration. And I'm going to be over on the put side of the equation, which is the right-hand side of the option chain. So I know that I've got that level of support at about 78. Now, in this particular case, I don't want to take possession of the stock, but I'm comfortable taking possession of the stock if that circumstance occurs. So I'm going to look at selling just at, or maybe just below, just at or just below that level of support. So in this particular case, I'm going to look actually right around that 78 strike price. That's right at my level of support that the stock is bouncing up from at this particular point. I could go lower, in which case I'm going to receive less premium. And if I were to sell a put option lower, I'm going to bring in less premium, but I've got a lower probability that the price of the stock is going to end up down below that level and put this strike price in the money and mean that I would have to take possession of the stock. So if I were to choose between a couple of these, I might look at, say, for instance, the 75 strike, which has a 30-cent delta, about a 30% probability of being in the money at expiration. I've got the 78 strike, the one that I was looking at, which was about a 44% likelihood of being in the money at expiration. And I might even look at going out a little bit and bringing in some premium. I'm going to bring in less premium by going, say, for instance, to the 70 strike, but I've got an even lower probability of being put the stock. Now, I'm going to split the difference here, and I'm going to go to the 75 strike, okay? I'm going to go to the 75 strike, and I'm going to look at selling that 75 strike put option. And all I did is I left-clicked on the ask price, or excuse me, the bid price for this option. So my midpoint is about $1.55. I'm going to try to work this order towards that midpoint, which in paper money it's typically going to fill near that price. So I'm looking to bring in about $1.55 of premium times 100 shares. I'm going to click on confirm and send, and I'm going to see that my max profit on this trade is $155 if I were to get filled at the midpoint. Doesn't seem like a lot until I think about what that means on a percentage basis relative to the price of the stock. The stock's currently trading at $78.95. My net cost if I were to buy the stock at the strike price minus the premium I brought in is $73.45. So what I'm going to do is I'm going to take $73.45 and figure that as my base. I'm going to use that $155 and we'll figure out what our percentage return is. So I'm going to come over here to my calculator, and what I'm making, 155 divided by 73.50, we'll call it 73.55, is about 2% return on this risk, and that's for 23 days. Now, that doesn't guarantee that that's always going to be the case. Doesn't mean that you can't be put the stock and lose more than that. That just says right now where this currently exists, selling this premium for $155, which is $1.55 times 100 shares, means that I'm seeing about a 2% return over about 23 days. Is that okay? I don't know. I can't make that decision for you, but we're talking through this process. So we're going to click on confirm and send. We're going to read through this order, make sure that this is what we want to do. Selling the 55 or the 75 strike put option, bringing in $1.55. Now we're going to put this in our cash secured puts and covered calls group. I'm going to go ahead and I'm going to click on send and fire that order off. That order filled. I brought in $1.75, so even better. Now, that isn't always going to happen. That's largely because the market started to move on me, number one. And number two, this is paper money, so those fills are going to be a little bit different. But guess what? Now I have an obligation. And that obligation is to take delivery of that stock at or if I am assigned at that strike price at $75 a share. If that happens right now, and I brought in some premium, my break even's down around 73. If I were assigned early to buy the stock at 75 and the stock's currently trading at 79 on the market, great. I buy the stock, turn around and sell it on the market. If, on the other hand, though, the price of the stock's trading at 70 and I have to buy the stock at 75, which gives me a break even of 73, then I've got a loss in the trade. So it's an important consideration, the trend of the stock and whether or not you're willing to buy it. So in this particular circumstance, the stock's doing what we want it to do. I brought in that premium. My expectation is that the value of this option contract is going to go down over time. And I can look at buying this contract back at a later date and eliminating the obligation and then doing it again. Now, some traders would say, well, I'm just going to let it go to expiration and go to worthless, because at expiration, this contract that we sold, this 75 strike call or put option, is going to be worth either intrinsic value or zero. And if the price of the stock keeps going up, this contract is going to be worth zero, and it's likely to go to expiration worthless. But there's always risk of movement. Could the price of the stock, could the price of Delta move down significantly, even in that last day ahead of expiration? Yeah. Or even if we're put the stock at 75, and then over the weekend, could the price of the stock move down? Yeah, absolutely. Okay. So that being the case, that's where we have that potential risk in this trade. So I'm going to go to my monitor tab. I'm going to come back down to my cash secured puts and long options group. And here's my Delta Airlines cash secured put. I've got a column here that says trade price. And my trade price for this call option was for this put option was $1.75. So it's already starting to work in my favor. I want this contract to get cheaper because I want to be able to buy it back for less. So I sold it for $1.75. It's currently trading at $1.51. So I've made a little bit of money on the deal at the moment already. If I were to close this down, if I were to want to close this down at this point, it's as simple as right-clicking, creating a closing order, and buying this back and saying, I'm going to buy this back for $1.55, wherever that midpoint is. I'll move it towards the mid, buying it back for $1.52 or less, and then firing that order off and closing that trade down. That's as simple as it needs to be to create that closing order. Okay? So that's selling the cash secured put and then looking at buying it back at some point. Now, could we set a limit order to buy it back? Yeah, absolutely. If we wanted to take this trade off when it's done the majority of the work that it can do for us, we can go back to that monitor tab, and let's say if I wanted to close this trade down when it's currently trading at 20 cents or less, which it may very well do if it gets close to expiration, and the price of the stock continues to go up, I can create a closing order that says buy this contract back, and I'll just make my limit price 20 cents, and we'll make that good till canceled. We'll look at buying this back when it's done the majority of the work for us, and then we don't have to hold it to expiration. Now, we're sacrificing a little bit of that potential gain and a little bit of that percentage return, but we're getting out of the trade positively prior to expiration. We're going to click on confirm and send. We're going to leave this here as a working order, and we're going to send that off. And now that's sitting there as a working order waiting to close down that Delta Airlines trade, that cash secured put, if the price of the put option trades for 20 cents or less. And our expectation is that the price of that stock is going to continue to move higher. Let's look at another example. That's one. That's Delta Airlines. Let's take a look at this one. And this is MU. And some of you are probably familiar with this particular stock. It has had a pretty good run up in the last little bit. It's got an earnings announcement over the horizon here on the 24th of June. Yeah, Trader Joe, Delta Airlines sitting up as a fleeg if we're Canadian, as Barbara is. But we got a little bit of a flag type of pattern going on here on MU as well. Now, this is a pretty hefty price stock, right? Currently trading at $8.71. And the reason that I want to look at this one really quickly here is I want to illustrate what that capital requirement looks like in terms of this position to be able to initiate this cash secured put option. So the price of the stock kind of bouncing up off of this level of support. We've got that level of support right here at around 820. We're going to call it 820. Now, a couple of other things that I noticed here looking at the chart. One, I've got an earnings announcement over the horizon. Two, implied volatility is very high. So as a matter of fact, the implied volatility is about as high as it's been over the course of the last year. These premiums are going to be juicy, juicy, juicy. They got a lot of implied volatility in them, especially these put options. Because I will tell you, there's probably a lot of long stock positions where options traders are buying put options to protect against that downside move. So there's probably some juicy premium. Now, when I say juicy, I'm not saying that as necessarily attractive, because juicy comes as a function of the potential for movement, because the price of the stock could move up or it could move down. So we're going to do a short-term cash secured put, and our intent here is not to take delivery of the stock once again. All right? Okay. So Victoria asked the question, when we buy the option back close to the order, the amount bought back is the premium we are collecting. The amount that the difference between what we sold the put option contract for and what we buy it back for, that's the amount of premium that we get to keep. So I'll go through that in this example as well, Victoria. So good question. So I'm going to go to the trade tab, and we're going to take a look at MU. By the way, speaking of feedback, there's a feedback survey out there in the chat. Do me a favor, fill out that feedback survey. Let me know what you think and how we can make these webcasts better for you. So I know that I've got that earnings announcement over the horizon. My guess is, just by looking at where implied volatility is, that that's going to be this week right here, the 26th June. So I'm going to sell the 18 June expiration, 9 days, and we'll see what we can do with 9 days to go. Still have an expectation that the price of the stock is going to go up. I want to sell at or below that level of support that I identified on the chart, which we said was at about 820. Stock's currently trading at 866, 867 on the price. So we're going to go down here. I know that I've got that support level at about 820. So that's going to put me right down here at about the 815 strike. Now that 815 strike has about a 30-cent delta. That's going to be about a 30% probability, 33% probability that this option is going to be in the money at expiration, which means it's got about a 70% probability of being out of the money at expiration, which is exactly what I want to have happen here. Now, I'm selling this for a pretty fair premium, $37 per share times 100 shares. So if I click on the bid price here, 37.55, it's bouncing around a lot here as we start to see this moving. That means that I have to be willing to buy the stock at $815 a share. That means if I click on confirm and send, I've got to hold $77,900 in cash. Now, for some traders, that isn't a problem. They have ample amounts of cash in their portfolio. For some traders, that might be a problem, and that might necessitate looking at a different stock, using a different strategy like a vertical spread, which we're going to talk about next week. So holding that amount of capital, that also then becomes our potential max theoretical loss. But I've got to hold $77,900 of cash to satisfy the obligation here if the stock is put to me. In exchange, I'm bringing in $3,600 of premium. So once again, on a percentage basis, for 9 days, that's a pretty good percentage return. Not a guarantee, not a recommendation or anything else. We're going to put this in our cash secured put, but that's giving us our idea of how much capital we've got to hold in this particular account. And again, it's going to be dependent on your account, whether that meets your position size, capabilities, and comfort level or not. So we're going to look at selling this cash secured put right at that 815 strike price. So we're going to go ahead and we're going to fire that order off. We got it for 36.10. Now what that means is if we go to the chart here, and let me grab my magic marker so that I can draw this in, our strike price is right here at the 815. That's right about there. So our expectation is the price of the stock still does this. If the price of the stock does this, okay, we put the stock right there, which is our break-even price, the price of the stock, which is the 815 strike, minus the amount of premium that we brought in, the $36. So $36 below 816, that's going to be where we're going to be put the stock. And now we have that obligation to buy the stock. We own the stock. So if the price of the stock keeps going down, we're on the hook for those potential losses. All right. So that's a possibility. If it goes up, great. That works in our favor. If it goes nowhere, if the price of the stock doesn't move at all, as long as the price of the stock stays sideways and we know that time decay is going to pass and implied volatility is likely to fall, cool, great. That works in our favor as well. In fact, the price of the stock could fall from 871 down to 815, which is the strike price, minus $35, which was the premium that we brought in, equals our break even. So we could be wrong and still make money in this trade. We could be wrong directionally and still make money in the trade. But below that level is where we start to incur ownership of the stock and loss in that ownership of the stock, right? So that is something that we have to pay attention to. This is not a set it and forget it trade. We have to be aware of what the price of the stock is doing. So that's getting into a trade like this, and in this particular case. So we have to be willing to own that underlying stock. Let's look at one more example here, and then we'll talk through some of the other considerations. So the other one that I'm going to look at is Abbott. This might look a little bit differently. ABT. This is Abbott. And this is another way that some traders will use um, a cash secured put. So in the event that Micron trade that we just did, we were doing that for 9 days, right? Because there's a lot of premium to be had. There's an earnings announcement. We want to be done with the trade. We want to be done with that trade um, prior to the earnings announcement, and maybe we roll it out and further, or maybe we just keep it there. So this goes into Charles' question. What do you do when the stock price falls below the strike price? Do you roll or get assigned? You could, either one, right? If you don't want to take possession of the stock, you could buy back the contract, eliminate the obligation, or buy back the contract and roll it out for time and keep the trade going. So we'll look at that here in this particular case, right? Can you sell early? Yes, absolutely. You can sell that contract back or buy that contract back is another way to think about it, because you're selling it to begin with. You can buy it back at any time, which is the great flexibility of the contract. So price of the stock's rallied up. It's bounced off of this level of support here at about 88. So we're going to go to the trade tab. We're going to take a look, and I'm going to go a little bit further out in time. I'm going to go out to the 17 July. So we know that we've got a support level at about 88, which means that the 87.50 is inside my support level. I'm going to go actually to the 85 strike here, and we're going to look at selling the 85 strike. And I'm going to do that for 38 days. So I'm bringing in a little bit of premium here, looking at selling this. Now, here's the thing to think about. We go ahead and we can click on confirm and send and order this up. So now 8,345 is how much we have to hold in our account to satisfy this obligation. We're bringing in that $1.55 again. And that brings it back down to maybe a little bit more manageable for some traders in terms of capital efficiency. This is still not very capital efficient when you think about it, because it's tying up that capital, but it is an effective way, if you've got a lot of cash in account, to generate income. So we're going to go ahead and fire this order off. Now, the thing about this is a stock that has been trending down. It's now given us this kind of skewed double bottom pattern, maybe breaking back out, but it could move back down to the downside. And it might dip back down and then rally back up, as it's done a couple of times here. So if we wanted to keep this trade going, one of the things that we could do, and I'll just come back over here to our trade, is if I wanted to continue this trade going forward in the future, I could right click and I could create a rolling order, which would mean then that I could buy back the one that I just sold and then sell another one further out in time. And this is going out another week out in time. And I'm able to do that. Same strike price, bring in a little bit more premium. So what I'm losing here is the width of the bid-ask spread, because I just sold it. Now I'm buying it back and I'm selling another one. So I probably wouldn't do this. I would probably wait for a little bit of time decay to occur, but it's just moving this trade on, and that's all a rolling order is. But you got to remember that a rolling order isn't a magic wand. It's not taking out any transaction costs, and it's dependent upon the liquidity of the target that you are rolling to. But you could certainly roll out for time or duration. You could roll out and up for time and strike price. What I maybe wouldn't necessarily consider doing is rolling out and down to try to capture premium on a downward trending stock, because then you've got kind of a diminishing spiral. If the price of the stock is moving down, again, you have to answer the question, am I really, truly, honestly willing to buy this stock? Because you might have to. So I'm going to go ahead and I'm going to fire this rolling order trade off just so that you can see it. And all I'm doing is I'm accomplishing that roll from one expiration to another at the same strike price in this case. And that roll just happened. Again, these are both liquid targets. So I was able to buy back the one that I sold and roll it out to another expiration. All I did, and the reason I did that, was just to simply demonstrate the roll process. Probably not going to roll it at that point, but here's the other thing to think about. To Victoria's question, when you buy back to avoid assignment and decrease the premium, thinking about that early assignment risk potential, and I'm going to come back over here to my monitor tab because I've got a couple of these positions here that I maybe want to look at closing. Let's see if I've got one in here. I think I've got another cash secured put. Okay, here's a good example. Okay, so this is Carnival Corp. And I sold a cash secured put. It now has 9 days to go until expiration. It's getting down to the end of that lifespan. I sold it for $1.27. It is currently trading at 52 cents. I am short the 26 put. So let's go to the chart really quick. CCL. And again, not a recommendation here. Okay. So, but Carnival Cruise looks like it's pulling back a little bit. Implied volatility is still rising, which is working against me. And I've got that earnings announcement over the horizon. So if I didn't want to buy the underlying stock, I could simply close this down. But there is a possibility that ahead of this earnings announcement, I could be assigned early. I don't want to be fearful about that because all I need to do then is turn around and sell the underlying stock if I don't want to hold it. There is some positional risk, but assignment is not something to be fearful of because we've already accounted for it in the holding of the cash to create this as a cash secured put. So what I'm going to do in this particular case is I'm going to just simply close this position down. I've captured some premium that I could get, but implied volatility is starting to go against me. I've got that earnings announcement. I don't want to hold through that earnings announcement, so I'm just going to close this trade down by creating a closing order, and I'm going to buy it back. So now the difference between the $1.21 that I brought in to begin with, Victoria, and the 53 cents that or whatever it is, 58 cents that I'm buying it back for, that's the amount of premium that I get to keep. So the more premium I get to keep, the better, right? So it's in my best interest to hold this closer to expiration, but I want to balance that with the likelihood of being assigned or taking possession of the stock. So I'm going to go ahead and click on send and fire that order off, and I've now eliminated that position. All right. So I'm going to show you some additional resources here really quickly. Again, the Trader Talks webcast page. Come back over here and type in the words cash secured put. And now you've got a bunch of webcasts that talk about cash secured puts and how to utilize that strategy. So some great resources there. We just ask that you click on subscribe when you get there. Also, fill out that feedback survey as well. You can also follow me and Mike on social media. I'm at Ben Watson CS on X. Mike is at Mike Fairborn CS. So let's pop back over here to our slides for just a second. We'll talk through this. So again, some considerations. The account has to have enough capital to purchase the stock if we're assigned. Got to have that as the base understanding. If we're assigned, we want that total position to be in alignment with how many shares of that stock we want to own. If you've got a whole bunch of Micron shares already, you may want not to consider selling a cash secured put on Micron because you might end up with even more shares. And if that puts your allocation over that limit or over your personal limit, that's something to pay attention to. You got to be aware of upcoming dividends and earnings announcements because those are potentially stock moving events that could create a circumstance where early assignment has a greater likelihood. Think about volatility. It's a consideration. If implied volatility is high, premiums are often higher. You may be able to capitalize on those juicy premiums. If implied volatility is low, generally those premiums are going to be a little bit lower, may not be as beneficial from a percentage return basis. And if that implied volatility rises, that can work against you as the trader or the seller of a cash secured put. So think about buying the trade back 4 to 10 days prior or exiting at a 75 to 80% profit. Exit the position, buying back the cash secured put if the price of the stock breaks a support level, if you don't want to own the underlying stock. If you do want to own the underlying stock, well, then you might just let the stock be put to you and take advantage of that premium that you brought in to be when you sold the cash secured put to begin with, but recognize that the price of the stock could move and you've got now position risk. So we talked about what a cash secured put is, talked about some of the basics. We looked at a couple of different examples here. So going forward, you've got those webcasts. Next week, we're going to talk about short put vertical. So I'm going to show you on something like MU how you can take that $77,000 requirement to hold that short position down to maybe 700. We'll see if that can work. So if you want more information about that, join me next week at the same time when we talk about cash secure, or excuse me, short put vertical spreads. Fill out that feedback survey. Again, my thanks to Michael Fairborn. My thanks to our great reviewers and production staff for helping out. I appreciate all of you here, whether you're here for the first time or you've been here for the 100th time. Have a great day. We'll see you again soon. Take care. Bye-bye.